Most good habits are learned best and they work well when you start early. The same is the case with investing. The earlier you start, the better it'll be for you. Remember the power of compounding? If you remain invested in a market-linked instrument such as an equity mutual fund for a long time, the returns could be earned on your invested money and then further on the accumulated returns as well. In short, you'll earn returns from your previous returns. And the more time you give to your investment to earn more returns for you, the more wealth you'll create for yourself. Let's consider an example. Suppose you and your friend Jay invest the same amount of money over a period of 10 years, but you both do it slightly differently. While you decide to invest ₹500 monthly, which sums up to ₹6,000 every year, Jay starts investing in only the 6th year and he invests ₹1,000 monthly, which sums up to ₹12,000 every year. Let's say you both earn 12% cumulative return annually. How do you think the investments will pan out? Even though you both invested the same amount, a total of ₹60,000, you will have earned significantly more wealth than Jay. That's because you started investing sooner. And also, the returns you earned in the early years increased your capital invested earlier and therefore earned you more returns. This is why it's best to start investing sooner and to keep the returns cumulatively invested. Now the question is of how much to invest every month. Keep it simple. Your financial goals should ideally determine how much money you need to invest. As a general rule, keep 6 months of expenses saved in your bank account to deal with any emergencies and to fulfill your short-term needs such as buying a new car or taking a holiday within the next few months, etc. To meet your long-term financial goals such as buying a home, retirement, etc., you need to invest smartly and for a longer duration. In order to figure out how much to invest, realistically estimate how much your goals will cost you in the future, keeping inflation in mind. Now, calculate how much you need to invest each month to get to that amount considering your investments will need to beat the rate of inflation. Let's say you've already accounted for your short-term needs and have started to invest for your goals. What if you still have excess money left in your bank account? Simple. Invest that excess money as well. Don't let it remain idle. Even if you start by investing a nominal amount, for example ₹500 per month, you are at least taking the first steps towards fulfilling your financial goals. With time, if you receive a windfall bonus or a lump sum, then invest that as well as soon as possible. However, make your investments wisely after studying various investment options. Remember, you can always visit an investment advisor to help you understand how should you be investing to achieve your financial goals. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.